Would you like to be able to buy a ready-made dividend growth portfolio? Save yourself the work of researching and picking stocks that fit the dividend growth strategy? There's a way to do that, and in this video, I'm going to show you how. My name is Dave Van Knapp, and today we're going to talk about ETFs, exchange-traded funds that hold dividend growth stocks. I'll even pick out one for you to consider. Before I get started, I have a small ask. If you like this content, please click the thumb up, subscribe to this channel, and ring the bell to get notifications about new videos that we produce. Thank you. Let's talk for a second about ETFs. I want you to understand how they work. The letters ETF stand for Exchange Traded Fund. An ETF is a fund of companies rather than an individual companies. And the initials each are important and stand for something. The ET stands for Exchange Traded. In other words, an ETF's shares trade on exchanges throughout the day, just as individual stocks trade. So the trading of an ETF share and the trading of a stock share, from your point of view as a shareholder or as an investor, will look exactly the same. The F stands for fund, meaning that an ETF is made up of multiple holdings. It is, in essence, a ready-made portfolio. So you can buy one share of an ETF, and in buying that one share, you're getting slices of shares of all the stocks that the ETF has in its portfolio. So ETF shares are bought and sold throughout the day on exchanges in the usual way. Each one has its own ticker symbol. You enter orders just the way you're used to doing for stocks. The price of the ETF generally matches the net asset value, which is the total value of all the stocks or all of the assets that are in the ETF. As those assets' prices change during the day because they are being traded individually, the ETF's price keeps up and changes accordingly. The first ETF was introduced in 1993. From that single start, which was an ETF that matched the S&P 500 index, there are now more than 7,600 ETFs worldwide, and more than 2,200 of those are based in the United States. ETFs have become a huge industry. More than $7 trillion is now controlled by ETFs. And estimates are that ETFs make up 25 to 30% of the trading every day in the stock market. Now let's talk about the dividends that come from ETFs. First of all, I have come to believe that one can follow a reasonable dividend growth strategy using ETFs. And certainly an ETF can be one element of a dividend growth portfolio. I've been studying ETFs for more than 8 years. The reason for my individual interest in ETFs was because of a simple question, which is, what if I die? All of my wife's and my investments in stocks, which is to say most of our investments in anything, are in dividend growth stocks, individual ones, and I manage those portfolios myself. If I pass away, what will my wife do? Well, one logical potential answer to that question would be to replace individual stocks, get rid of the management tasks and responsibilities around individual stocks, and replace them with one or two or three or four well-chosen ETFs. So that's why I started to look at ETFs a few years ago. My hope was that I would find some dividend growth ETFs that came pretty close to what I'm able to accomplish investing in individual stocks. Before I reveal my ETF pick for this video, we need to understand a couple of facts about the dividends that come from ETFs. First, ETF payouts vary from quarter to quarter. You can see that variability on this graph. This is a 10-year chart showing the dividend payouts from Johnson & Johnson, which is an individual company, and is the purple line on this graph, and compares that to the orange line, which represents an ETF that holds dividend aristocrats. All ETFs are like that, with a jagged pattern. The second thing I want to tell you about ETF dividends is that you cannot calculate the yield by multiplying the most recent quarterly dividend by 4 and then dividing by the current price. The reason you can't do that is because of the jagged nature of each dividend payout. Your yield calculations would themselves jump back and forth because of the varying payouts per quarter. So how we calculate an ETF's yield is to take the 4 most recent payments that are already in the books, add them up, and divide that total by the current price. That tends to understate the yield of the ETF that you will experience if in fact the dividends are in an uptrend, but it's the best way we have to calculate the yield. There's no way to project forward what the dividend payouts are going to be because of the variability that we've seen. Okay, I promised you that I was going to pick out a particular ETF to discuss in this video, and I just want to say a couple of words of how I got there. For this video, I boiled down the 140 dividend ETFs to just 11. I did that with 2 simple screens. First, I looked at the size of the ETF. I wanted well-established ETFs. And so I looked at, I sorted the ETFs by their total value, and I took the top 11, which were the ETFs, any ETF, dividend ETF that has more than $4 billion in assets under management made my final 11. The second screen I used is simply the dividend increase streak. Looking at the annual dividend payouts per year, which of course with an ETF are like this, but doing the adding 4-quarter exercise that I talked about before, I took every ETF, no matter what its size, that had a streak of 5 consecutive years or more where the annual dividend went up each year. The 11 ETFs that exercise led me to are shown here. Don't try to absorb all this information now. I will put this table back up at the end of the video and leave it on screen for 10 to 15 seconds. You can pause the video there and look at the table as long as you want. The green and orange colors on the chart indicate good and bad qualities of ETFs, and I'll give you a couple of examples. One example would be how long is the dividend increase streak. Many investors, including myself, don't consider a stock to be a dividend growth stock unless it's raised its dividend at least 5 years in a row and that streak is still active. So on the chart, I colored in in green, the ETFs that have dividend increase streaks of 5 years or longer. On the other hand, something like a high expense ratio, all ETFs charge fees for what they do in constructing and maintaining their portfolios. And those expense ratios can vary widely. So in general, a low expense ratio is a good thing and a high expense ratio is a bad thing. So in the last column, I put in green the ETFs with a very low expense ratios, and I put in orange the ones that have the highest expense ratios. I put all of the good and bad qualities of those 11 ETFs through a little scoring system, and I found one that I like above all the others. My favorite is Schwab's U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD has been very popular since it was introduced in 2011. It's accumulated over $36 billion in assets in 11 years' time. Okay, here are the things I like about SCHD. Kind of the overall theme of what I'm going to say is SCHD takes an approach to selecting stocks that has a lot of similarities to what I do in selecting stocks. That means that it focuses on company quality, fundamental strength, the sustainability of the dividend, and the yields of the companies that it selects. Let's go through this chart quickly, what I like about SCHD. The left column says selective as to stocks. I like that. I don't want an ETF portfolio that's so large that it essentially represents some of everything. I want selectivity in my portfolios. I've always been very selective about the stocks that I pick, and I appreciate an ETF that is selective about the stocks that it picks. By its own rules, SCHD is limited to 100 stocks. All of the companies are based in the United States, as are all but one of the companies that I have in my own dividend growth portfolio. It's reconstituted each March, which means that once a year, SCHD, or that is to say the people that run the underlying index for SCHD, go through the portfolio and reconstitute it, drop stocks that no longer meet their selective criteria, and add stocks that do. They do, however, employ buffers that slow down churn, and I also like that. I've always had a default approach of my own that says once I own a stock, the default action is to continue to hold it unless I have a real good reason to sell. That holds down my portfolio turnover usually at under 10% per year. SCHDs is higher, but I do appreciate the fact that they apply buffers and show an inclination to hold on to stocks that they've already selected rather than constantly churn the portfolio. Moving on to the second column on quality, SCHD uses 4 screens. In my own investing, I use more than 4 screens, and they're not all screens. Some of them are grading systems to pick out nuances between stocks. But the underlying idea is the same. It's to be selective. And SCHD requires that any stock that it puts in this portfolio has paid dividends for at least 10 straight years. Moving to the next column on dividend yield and growth, SCHD has a decent dividend yield of 2.8%. I put that in what I call mid-range, which I consider to be anything between 2 and 4% to be mid-range. And for something with that level of yield, I like to see a pretty fast growth rate, annual growth rate in the dividends, and SCHD delivers on that. Its past 5-year growth rate has been fast at 12% a year. I think I may have mentioned that SCHD has 10 straight years of increases. The last thing I like about SCHD is its weighting and capping system. In general, it's a capitalization weighted index or portfolio, as is my own dividend growth portfolio. They limit a single position to occupying no more than 4% of the portfolio at the time of the annual reconstitution in March. I use a higher cutoff myself at 8%. They limit a sector, any particular sector of the economy, to 25% of the portfolio. They rebalance to their target weights 4 times a year. All of these things lead to a diversified portfolio, a decently balanced portfolio, and I like the whole scheme. So using that process, what does that get you? This display shows the holdings in SCHD divided by the sector of the economy that are represented by the stocks. In the left column are 5 sectors that all exceed double-digit percentages in SCHD's portfolio. So you can see that SCHD is heaviest in financials, information technology, industrials, consumer staples, and healthcare. This display is Morningstar's famous style box that shows how portfolio is divided as to the size of the companies that it holds, small, medium, or large, and the style of investing, which is divided into value, growth, and then a middle category that they call blend. And you can see that 78 of the stocks in SCHD's portfolio are large cap stocks, and that 38 of those are straight value style, and another 40 are what they call the blend category. There are no stocks that Morningstar categorizes as growth stocks. So in total, this would be called a large cap value fund. This is a display also from Morningstar, and I'm putting it up just to show you how their quality screens, SCHD's quality screens, result in a high quality portfolio. That red bracket at the top brackets wide moat and narrow moat stocks. That's a designation applied by Morningstar, and if you add up the percentages, 83% of the weight of the SCHD portfolio has either a wide or narrow moat. That's a high indicator of quality. The 2 red dots next to financial health and profitability, I put those red dots there to indicate that Morningstar also assesses SCHD's stocks as having a high financial health grade of B+ and very good profitability with a grade of B. This display shows SCHD's top 10 holdings by weight. The weight of the highest holding, Home Depot, is 4.5%, so it's exceeded the cap of 4%, we know it was just rebalanced in March. So Home Depot's price has been going up. That's how it's risen beyond the 4% cap. They'll catch that at the next rebalancing in a couple of months. The 10 stocks shown here, as I said, are the top 10 holdings by weight in the portfolio. And together they comprise 41% of the total size of SCHD. I put red dots next to holdings in the ETF that match holdings that I have in my own dividend growth portfolio. And there are 5 dots out of 10, red dots meaning that 5 of the stocks in SCHD I already own to one degree or another in my portfolio. That tells me 2 things. First, it tells me that our processes are somewhat similar. They're leading both SCHD and myself to some of the same stocks. But it also tells me that there are some differences. We saw earlier that SCHD is largest sector's financials, and I think in my dividend growth portfolio, I don't have any financials. So SCHD comes across to me as one that uses a process that's similar to mine, but yet has, in the end, that has led them to stocks that would provide a diversification element to my portfolio if I were to add SCHD to my portfolio. I put green dots next to each company that has either a wide or narrow moat from Morningstar, just to reemphasize the quality. They're all 10 stocks in this chart have a green dot. Everyone is given a moat, and most of them are wide moats by Morningstar. This chart, which is from Simply Safe Dividends, shows SCHD's annual dividend growth. As I said, they've grown the dividend every year since they were introduced in 2011, and these are annual total dividends, so it takes the jagged line, adds them up 4 quarters at a time to get the annual payout per year. Since it's gone up every year, the annual payout has gone up every year. That's how SCHD has compiled its 10-year record of dividend growth. Towards the upper right, you can see that the growth over the past 5 years, the growth rate has been 12% per year, as we discussed earlier. This display gets a little more granular about SCHD's dividend payouts. It shows the payout per quarter, and as you can see by the graph along the bottom, SCHD is not immune to the ETF characteristic of having varying payouts each quarter. So you can see that, but when added up, you get the smooth annual increases that we saw on the previous display. This graph shows SCHD's total return with dividends reinvested over the past 5 years and compares it to the 4 next largest dividend ETFs from my table of 11 such ETFs earlier. I don't use total return as one of my selection criteria in dividend growth investing, but it's nice to know that your portfolio is returning a good total return. SCHD is the top line here, the purple line, and it is that 117.6% return is the total return with dividends reinvested over the past 5 years, which is a very nice return and better than any of the other dividend ETFs that I looked at. In fact, over the past 5 years, SCHD has ranked in the top 2% of all large value ETFs. I can also say that SCHD has kept pace with the S&P 500's total returns with dividends reinvested over the past 5 years. And I'll just display this slide, which shows SCHD's dividend yield compared to the S&P 500's dividend yield. And you can see SCHD, as you would expect and hope for a dividend-oriented ETF, yields more than twice as much as the S&P 500. Currently, SCHD yields 2.8%, while an ETF that holds the S&P 500 stocks yields 1.3%. Okay, I said I would talk about the pros and cons of SCHD. I really don't have any cons. I don't have any negatives at all with SCHD. I think it is a fine dividend growth portfolio, run very well for all the reasons that I've been discussing for the last few minutes. I do realize that at 2.8%, its yield may be too low for some dividend growth investors. That is right on the borderline for me of stocks that I personally invest in. And you should know that SCHD contains no real estate investment trusts. That is by rule. It simply does not invest in the real estate sector of the market. And because it favors higher yielding stocks over lower yielding stocks, you don't find the Apples and the Microsofts and the Visas that have very low yields, say of 1% or less, but are growing the annual payouts 20% a year. Those stocks don't appear in SCHD. I don't consider that a negative, but it's something you should be aware of. It's not easy to place valuation or fair price estimates on ETFs because they hold so many stocks, and valuation really depends on what the valuations of those individual stocks are. But I did my best to take a few shortcuts and to find different ways to value SCHD. And this slide shows what I came up with. A fair price of $70, I think, is appropriate for SCHD. At that price right now, SCHD would be yielding 3%. So that's two different ways to look at fair value for an ETF with a portfolio. You can look at the price itself per share, as we normally do with stocks, or you can look at the yield. When the yield hits a certain number, you can say that's when I'd be interested in buying, but not when it's less than that. Going to the left-hand column here, a deep discount price on SCHD I think would be $63 a share, and the yield at that price would be 3.3% or higher. Either of those conditions would represent, I think, an extremely good deal on SCHD. Moving across to the third column, SCHD's current yield is 2.8%, and it's selling for around $75. And that would be just about near my upper limit to pay for SCHD shares. My true upper limit would be $77 or 2.7% yield per share. Just to wrap up this video, I'd like to say that I'm very impressed with SCHD as an ETF. Its combination of quality, selectivity, yield, fast dividend growth, very low expense ratio, I think makes it a fine choice as a potential resident in a dividend growth portfolio. It is a dividend growth portfolio all by itself. My intention is, since my public dividend growth portfolio is meant to be a demonstration of dividend growth investing, that when I can get the right price and the right yield on SCHD, I'm going to start adding shares of it to that portfolio just to let everybody keep track of how it does versus the individual stocks that are in that portfolio. I want to disclose that my wife and I own SCHD. We've owned it for about 5 years. I picked it out as a result of a similar research exercise several years ago. It's lived up to all my hopes and expectations. It's been something I haven't had to pay attention to at all. They run the portfolio. I simply own the shares. I would like to thank you all for watching. I will be back in about a week with a report on my dividend growth portfolio. Before we finish the video, I'm going to keep my promise and put back up the chart of the 11 large dividend ETFs. We'll leave that on screen for 10 seconds or so. If you want to study it in detail, just of course pause the video and you can hold it on screen for as long as you want. And that wraps up this video. Thanks a lot again, everybody. Bye-bye.